The average price of gas now $4.11 a gallon.
Price of food increased globally in the Strait of Hormuz.
I expect layoffs to rise.
You went to the grocery store last week? Maybe you bought the same things you always buy. Same cereal, same chicken, same brand of olive oil. And somehow the total was higher. Again, you didn't eat more. You didn't buy anything special. You just paid more. And you didn't say anything because at this point, what's there to say? Grocery prices in 2026 are up about 25% compared to 2020. Not 25% once, but 25% permanently. That new price floor is just your life now. And here's the thing nobody is telling you. It's not going back down. Not when the war ends. Not when oil stabilizes. Not when the next president promises to fix it. The world that made your cost of living affordable, that world is gone. And in this video, I'm going to show you exactly why. You might think this video is about the Iran war, or gas prices, or whatever the headline is this week. It's not. Think back to the 30 years between 1990 and 2020. Or if you weren't around for all of it, ask someone who was. Because during that period, something almost unprecedented happened. Everything got cheaper. Not just a little cheaper, dramatically cheaper. The oil that heats your home, the food on your table, the clothes on your back, the phone in your hand. Year after year, the cost of living stayed manageable, affordable, almost reasonable. And most of us just assumed that was how the world works. It wasn't. That was a 30-year accident. Here's why. In 2001, China joined the World Trade Organization. This means the world gained access to the cheapest manufacturing base in human history overnight. Within 5 years, prices on manufactured goods in the US dropped by nearly 8%. Not because companies got more generous, but because 1 billion people in China suddenly entered the global labor market at a fraction of Western wages. Meanwhile, Middle Eastern oil kept the whole system running on cheap energy. Shipping costs were low. Inflation stayed quiet. Governments called it prosperity, but it was just luck. A rare alignment of cheap labor, cheap energy, and open borders that had never existed before and may never exist again. And one by one, those conditions have collapsed. It didn't happen all at once. It happened in 3 layers, and most people only understand the first one. The first layer is COVID. It broke a supply chain system that had kept prices low for 30 years. And nobody ever really fixed it. The second layer is a 21-mile stretch of water in the Middle East that most people couldn't even point to on a map, and yet controls the price of your groceries, your energy bill, and the interest rate on your mortgage. And the third layer is the one nobody's talking about yet. The hidden inflation that hasn't fully hit your wallet, the wave that's already been set in motion and is still coming. So let's go back to the beginning. From 1990 to 2020, the world went through what economists call the era of globalization, and the idea behind it was simple. Instead of making things expensively at home, countries outsourced everything to wherever it was cheapest. China made your electronics and your clothes. The Middle East pumped your oil. Giant cargo ships carried it all across the ocean for almost nothing. And because labor was cheap, energy was cheap, and shipping was cheap, the things you bought stayed cheap too. It was a machine. And for 30 years, the machine worked until 2020, when COVID shut the whole thing down. Factories closed overnight. Supply chains that had been running on razor-thin margins with almost no backup inventory just stopped. And when the world tried to turn back on, demand came roaring back faster than supply could keep up. Shipping containers were in the wrong places. Ports were backlogged. The cost of shipping a single container from China to the US went up over 1,000% from 2019 levels. Supply chain disruptions alone drove roughly 60% of the surge in US inflation that started in 2021. People said, don't worry, when the supply chains recover, prices will come back down. They didn't, not fully. Prices settled at a new higher floor, and then in February 2022, before anyone had properly recovered from COVID, Russia invaded Ukraine. Now you might be thinking, why does this matter to me? I'm not even close to Europe. But here's the thing. Ukraine and Russia together supplied around 30% of the world's wheat exports and 20% of its corn. Ukraine alone was the world's largest exporter of sunflower oil. When the invasion happened, global food prices hit an all-time high. Wheat prices jumped 58% in a single month compared to the year before. The World Bank called it the largest commodity shock since the 1970s oil crisis. If you want to know more about 1907's oil crisis and Russia-Ukraine war, we'll do full videos about them in the future, so please subscribe so you don't miss it. Back to Russia and Ukraine war. Again, people said, don't worry. When the war calms down, food prices will come back down. Guess what? They didn't. Not to where they were. Another floor. Another reset. And now, in 2026, we have the third shock. A 21-mile stretch of water has been effectively shut down, cutting off 20% of the world's oil supply. 3 shocks, each one hitting before the last one had healed, each one resetting prices at a higher baseline than before. That's not a cycle, that's a staircase, and we're still climbing it. There's a theory that's been around for years. The next world war won't be fought with bombs, it'll be fought with supply chains, trade routes, and economic pressure, because countries have figured out that invading land is slow, expensive, and unpredictable. But cutting off what the world depends on, that's a much cheaper weapon. Iran understood this better than most. Iran doesn't need to win this war. It never did. It just needs to hold one thing, the Strait of Hormuz. It sits between Iran and Oman at the bottom of the Persian Gulf. At its narrowest point, it's just 21 miles wide, 2 shipping lanes, each about 2 miles across, and yet more than a quarter of all the world's seaborne oil passes through those 2 lanes every single day, about 20 million barrels every day. Now here's the thing most people miss when they hear about the Strait of Hormuz. They assume this is an oil story. It's not just an oil story, yes. 25% of the world's seaborne oil goes through there, yes. 20% of the world's liquefied natural gas goes through there, most of it from Qatar, which has no other way to get it out. But it's also the route for fertilizer, for aluminum, for petrochemicals, for sulfur, for helium. The Gulf region produces about 1/3 of the world's internationally traded fertilizer, and almost all of it has to leave through that same 21-mile gap. And Iran knows exactly what it controls. Iran doesn't need to win a war to hurt the global economy. It doesn't need to sink a U.S. aircraft carrier. It just needs to make that strait unusable long enough for the damage to become irreversible. And right now, it's doing exactly that. But here's the part of the story that almost nobody is covering, and it's the part that will affect your life more than any of the others, and that is fertilizer. Right now, as you're watching this, farmers across the American Corn Belt are in the middle of spring planting season. Iowa, Illinois, Indiana, Ohio, Nebraska. This is the window, a few weeks in April and May, when corn gets planted and nitrogen fertilizer gets applied. Miss this window and there's no making it up. The crop is decided for the year, and this year those farmers are facing a fertilizer crisis unlike anything in recent memory. Since the war started, urea prices, the most widely used nitrogen fertilizer in the world, jumped from around $450 a ton to over $650 a ton in under 3 weeks. That's a nearly 50% increase in less than a month. Some spot markets were reporting prices above $800. In mid-March, U.S. fertilizer supply was sitting at around 75% of normal levels, right at the start of planting season. So what are farmers doing? A lot of them are switching from corn to soybeans. Soybeans need less fertilizer. It makes financial sense right now. But corn is the feedstock for American beef, poultry, and dairy. Less corn planted this spring means a smaller harvest this fall. And a smaller harvest this fall means higher meat and dairy prices. Not this summer, but by late 2026 and into 2027. And guess what? The damage is already done. Even if the Strait of Hormuz opened, even if the war ended, the spring planting decisions have already been made. The fertilizer that wasn't applied isn't going back on. The corn that got switched to soybeans isn't switching back. Unlike oil, there are no strategic reserves for fertilizer. There's no emergency stockpile anyone can release. The American Farm Bureau president put it plainly. Fertilizer is not optional. It determines the crop yield, and the crop yield determines what you pay at the grocery store. The wave has already been set in motion, and we're starting to feel it. Now, be honest with yourself for a second. When you first heard about oil prices going up because of a war in the Middle East, did you think, okay, but I take the train, or I've got an EV, so this probably doesn't affect me that much? Maybe someone around you said that. Maybe you said it yourself. That reaction makes complete sense, and it's also exactly wrong. And here's why. Oil isn't just the thing that goes in your car. When crude oil gets refined, it produces something called petrochemicals. Think of them as the raw ingredients that manufacturers use to make almost everything around you, and we're talking about more than 6,000 everyday products. Your toothpaste, the plastic bottle your shampoo comes in, the packaging around your groceries, the synthetic fibers in your clothes, the tires on your bike, the pill coating on your medication, the foam in your mattress. You are surrounded by oil-derived products, and most of the time you have no idea. So when oil gets more expensive, it doesn't just show up at the petrol station. It shows up everywhere. Slowly, quietly, in ways that are almost impossible to trace back to a war 7,000 miles away. Think about how a product gets from a factory to your door. Raw materials have to be mined or grown. Then they have to be manufactured into something, then packaged in plastic, in cardboard, in foam, all petroleum derived, then loaded onto a diesel truck or a cargo ship burning bunker fuel and shipped across the world, then unloaded at a port, then driven to a warehouse, then driven again to your door. Every single one of those steps runs on oil. And right now, every single one of those steps is getting more expensive. Amazon just announced a 3.5% fuel and logistics surcharge on its third-party sellers. UPS and FedEx have raised their fuel surcharges too. UPS is adding an 8% temporary price hike on package deliveries starting April 26th. These companies aren't absorbing these costs. They're passing them to the sellers, and the sellers aren't absorbing them either. They're passing them to you. That's your Amazon order, that's your grocery delivery. But there's one more thing, and this one hit a lot of people somewhere they really didn't see coming. Their mortgage. 2 days before the US and Israel struck Iran in late February, the average 30-year fixed mortgage rate in the US fell to 5.98%. For the first time in over 3 years, borrowing costs had dipped below 6%. People who had been waiting on the sidelines for years, waiting for rates to come down enough to actually afford a house, finally had their moment. But this lasted less than 72 hours. The moment the war started, oil prices surged. That triggered inflation fears. Inflation fears caused investors to sell treasury bonds. When investors sell bonds, yields rise, and mortgage rates track the 10-year treasury yield almost exactly. Within weeks, the average 30-year fixed rate had climbed to 6.37%, nearly half a percentage point higher than it was before the war began. For example, on a $450,000 home with a 20% down payment, that difference cost you $1,346 more every year. Over the life of the loan, that's $40,000. One couple CBS News spoke to had been quoted 5.85% by their lender, finally within reach after years of waiting. By the time they were ready to sign, the rate had jumped to 6.49%. That's an extra $265 a month. $95,000 over 30 years, gone. Not because of anything they did, not because of the housing market, because of a war in the Middle East that moved the bond market, that moved the treasury yield, that moved their mortgage rate. That's the chain. That's how it all connects. Oil isn't just fuel, it's the invisible thread running through almost every financial decision you make. On April 7th, the US and Iran announced a 2-week ceasefire. Markets rallied. Oil dropped 16% in a single day, the biggest single-day drop since 2020. By April 12th, peace talks in Islamabad collapsed. The US announced a naval blockade of Iranian ports. The ceasefire expires April 22nd with no deal in sight. Quick note, I'm recording this on April 14th, 2026. This situation is moving fast and some details may have changed by the time you're watching this. But here's the thing. Even before the ceasefire collapsed, even in that brief window when people thought it was over, economists were already warning that prices wouldn't come back down quickly. There's a principle they call rockets and feathers. Prices spike like a rocket. They drift back down like a feather, slowly, over months. And that's just petrol. In terms of food, shipping, and housing, the delay is even longer. So the damage is already in the system regardless of what happens next. We covered the mechanics of that earlier. What I want to focus on next is something different. 2 questions. Who knew this was coming? And what they did about it. You might remember from our Polymarket video, the $580 million trade placed in oil futures, just 15 minutes before Trump posted about pausing strikes on Iran. If you haven't seen that one yet, I'll link it at the end of this video and in the description. It's worth watching before you finish this one. That trade was placed right before oil prices dropped. Whoever placed it made a fortune on the dip. The timing was too precise to be coincidence. And right now, that same pattern is playing out but bigger. Here's what the big players are doing. Hedge funds and institutional investors aren't waiting for resolution. They're not sitting on the sidelines watching the news. They're already positioned, long on energy stocks, long on fertilizer producers, long on shipping companies, short on consumer discretionary, the stuff ordinary people buy when they have money left over after paying for essentials. In other words, the people who move markets have already made their bet. Their bet is that this isn't temporary. Their bet is that your cost of living stays high, and they're putting billions of dollars behind that view. That's not a conspiracy. That's just how markets work. The people with the most information, the fastest access, and the most capital, they position first. Everyone else pays the higher prices later. The ceasefire was a relief rally for ordinary people. For the smart money, it was just a dip to buy. The last time the world went through something like this was 1973. The Arab oil embargo. Oil quadrupled in price almost overnight. Petrol queues stretched around the block. People thought it was temporary, a political dispute, something that would blow over. It didn't. Higher prices became the new baseline. Inflation stayed elevated for nearly a decade. The Federal Reserve eventually had to raise interest rates so aggressively it triggered 2 recessions in 1979 and again in 1981 just to get inflation back under control. But here's what's interesting about the 1970s. The people who adjusted their thinking early came out ahead, not the ones who panicked, not the ones who assumed it would all go back to normal, the ones who looked at what was happening and asked, what does this actually mean for how I make decisions now? The car industry is a good example. After the 1973 shock, people stopped buying big, heavy, fuel-hungry cars. Japanese manufacturers who built smaller, more efficient cars gained market share almost overnight. The shift in consumer behavior that happened during the crisis turned out to be permanent. The world after the oil shock was genuinely different from the world before it. And that's the frame I want you to take from this video. This isn't about doom. This is about updating your mental model to match reality. Because the world that existed from 1990 to 2020, cheap oil, cheap food, cheap everything. That's the anomaly. What we're living through now is closer to the historical norm. Higher prices for energy, tighter supply chains, more expensive borrowing. These aren't temporary disruptions. They're structural features of the world we're in. So what does that actually mean in practical terms? Before I go into this, I want to be clear. None of what follows is financial advice. I'm not a financial advisor. Every situation is different, and you should speak to a professional before making any major financial decisions. What I'm sharing here is based on what the data and the experts are saying publicly right now. Take it as context, not instructions. If you have a variable rate mortgage or you're due to remortgage in the next 6 months, the advice is consistent across every financial expert right now. Lock in a fixed rate. Fixed rate mortgages protect you from future rises. The Iran war has already pushed rates nearly half a percentage point higher in the span of 6 weeks, and with inflation running at 3.3% and rising, there is no clear signal that borrowing costs are coming down anytime soon. If you're thinking about a major purchase, a car, appliances, anything manufactured from petroleum-derived materials, factor in that prices are likely higher in 6 months than they are today. Not dramatically, but higher. The rockets and feathers principle applies here too. Prices went up fast, and they come down slow. And on food, the fertilizer story is the one worth watching closely. Not this summer, but by late 2026 and into 2027, the combination of a smaller corn harvest, higher livestock feed costs, and ongoing energy-driven logistics costs will push meat and dairy prices higher. If you want to plan ahead, that's the category to watch. None of this is cause for panic. The 1970s were genuinely hard, but people got through them. Economies adapted, industries changed, new energy sources emerged. The people who understood what was happening made better decisions than the people who were waiting for normal to return. You came in knowing prices were high. You leave knowing why. The cheap era wasn't normal. It was a 30-year accident built on cheap Chinese manufacturing, stable Middle Eastern oil, and supply chains that ran like clockwork. One by one, those conditions collapsed, and a ceasefire won't reverse what's already baked in. Most people are still waiting for normal to return, and you know it isn't coming. Now, I want to ask you something. Do you think rising costs are a political failure, something better leadership could have prevented? Or are they the inevitable result of a system that was always more fragile than it looked? Drop your thoughts in the comments. If this video gave you a clearer picture, share it with someone who needs it. That's how this channel grows. So, like, subscribe, hit the bell, and I'll see you in the next one.